Stop scrolling and listen. Today, Vietnam made a move in its currency policy that matters not only to traders and travelers, but to anyone watching emerging markets and cross-border money flows. Right now, the State Bank of Vietnam has adjusted the official reference exchange framework, and the market is reacting. If you hold foreign currency, follow global trade, or track banks that service emerging market flows, this update could change the short-term math on conversions, imports, and investment decisions. Over the next 22 minutes, I'll walk you step by step through what changed, why it matters, how it might affect everyday people and big institutions, and what smart next moves look like for different audiences, from Iraqi dinar watchers to exporters, importers, travelers, and savers. I'll keep the language simple, practical, and focused on the facts you can use. I'll explain the technical bits plainly, show the human impacts, and highlight scenarios worth watching in the coming weeks. By the end of this report, you'll know the details of the new dong rate, how central bank policy fits together with trade and inflation, and what signals global investors are reading from Hanoi's decision. Stick with me, this is the kind of move that causes tiny shifts today and meaningful ripples tomorrow. Today's announcement is framed as a measured adjustment to Vietnam's reference exchange rate and to the trading band that guides interbank moves. Practically, the State Bank of Vietnam set the daily reference rate a few Vietnamese dong higher than the prior session, moving the official baseline that commercial banks use to quote their buy and sell rates. That doesn't necessarily mean a dramatic overnight revaluation in the sense of a one-time, large reprice, but it does mark a policy stance. Vietnam is allowing the dong to reflect recent market pressure and slight strengthening against the dollar. In plain terms, people holding dong will see a modest increase in international buying power if the market follows the new baseline. Importers might get a small cost relief. Exporters will need to watch pricing because their competitive edge abroad can shift if the dong holds higher. The central bank is using the reference rate and trading band as tools to manage volatility while signaling confidence in macro conditions. Let's unpack what the reference rate and trading band mean for everyday transactions. The daily reference exchange rate is the official midpoint published by the central bank. Commercial banks add a margin above or below when they buy or sell foreign currency to the public. The trading band, usually expressed as a percentage above and below that midpoint, sets the ceiling and floor that tells banks how far they can move customer rates for that day. When the midpoint shifts upward, it lifts the entire range. For someone exchanging dollars for a dong, for example a traveler or an overseas worker sending home remittances, small changes in the midpoint can change the final amount received after bank spreads and fees. For businesses planning imports, even a few dozen dong per dollar can add up when invoices run into the thousands of dollars. That's why central bank nudges, even if numerically small, matter. They recalibrate the environment in which prices, contracts, and financial planning happen. Why would Vietnam make a cautious, upward adjustment now? There are several plausible motives that fit both short-term technical management and longer-term strategy. First, a slightly stronger dong can help reduce inflationary pressure by making imports cheaper, which matters if commodity costs or key inputs are priced in dollars. Second, a firmer currency can attract certain types of foreign capital by signaling greater stability and predictable policy, which matters for foreign direct investment and portfolio flows. Third, adjusting the reference rate can be part of aligning Vietnam's market signals with its growth ambitions. The government and central bank have been aiming for robust growth targets, and exchange rate management is one of the levers they use to balance growth with macro stability. That said, central banks act cautiously. They don't want sudden moves that unsettle exporters or create speculative flows, so a small, transparent adjustment is a common policy choice to communicate intent without provoking market shocks. Reuters and central bank briefings have pointed to these trade-offs in recent months. How big is small in this case? Numbers help. Based on the most recent official figures, the state bank set the daily reference rate in the neighborhood of 25,100 to 25,200 dong per US dollar in early January 2026, with the trading band remaining at roughly plus or minus 5% for commercial bank operations. That means the ceiling and floor for bank quotes sit several hundred to a few thousand dong apart, depending on the exact midpoint that day. Market quotes at major commercial banks reacted in line with the new midpoint, showing modest increases in buy-sell prices. For practical comparison, this moves the effective conversion by fractions of a percent for small transfers and by a noticeable but still limited amount for large invoices. The main point: this is an upgrade in value that matters more in aggregate than as a headline shock. If you're watching from Iraq or holding Iraqi dinar positions, why care about a Vietnamese dong headline? First, global capital flows are interconnected. Banks that operate in multiple emerging markets, including correspondent banks in the US, Europe, and Asia, adjust liquidity and risk pricing based on several central bank signals. A stable or firmer dong can change demand for dollars in regional money markets, subtly influencing conditions that ripple through to currencies like the Thai baht, Malaysian ringgit, and even to markets outside Southeast Asia. Second, for investment funds and traders who rebalance across emerging markets, a clean policy signal from Hanoi could shift allocations. Funds chasing higher growth with manageable exchange rate risk might increase exposure to Vietnam, potentially tightening liquidity elsewhere. The result is that currency moves in one country can reprice risk perception across a region. So, while Iraqi dinar holders won't see a direct one-to-one change from Vietnam's step, the broader effects on regional flows and correspondent banking practices are relevant to watch. What does this mean for Vietnamese importers and exporters on the ground? Importers will watch for the immediate benefit. If the dong stays firmer, the cost of foreign inputs drops in local currency, which can reduce production costs or allow businesses to lower retail prices. That can be good for consumers and for firms that rely on imported machinery, parts, or raw materials. Exporters have a more nuanced reaction. A stronger dong can reduce competitiveness abroad, because the same foreign price yields fewer dong when converted back. Exporters may respond by adjusting prices, improving efficiency, or hedging more actively. Importantly, many Vietnamese exporters already hedge currency risk or price contracts in dollars, so their sensitivity varies. The central bank's goal here is to balance these effects so that imports don't drive inflation while exports remain viable. Firms with dollar-denominated debt need close attention. A stronger dong eases repayment pressure, which can improve balance sheets. This is a living trade-off, and companies that act quickly to adapt pricing and hedging will fare better. What should individual savers and travelers do right now? For travelers planning a trip to Vietnam, a firmer dong means your dollars might buy slightly more local goods and services. Good news for holiday budgets if rates stabilize. If you hold dong in a savings account and plan to convert to dollars soon, you may benefit from the increased conversion power. But watch bank spreads and fees, those can eat into gains. If you're an expatriate earning in dollars and spending in dong, it's a net positive. For savers whose local lives are tied to the dong, the broader impact will depend on inflation and wages. A modestly stronger currency can help lower the price of imported goods, but wages and local prices adjust on their own schedule. The practical takeaway is prudence. Avoid panicked conversions or speculative bets. Instead, check bank rates, compare fees, and consider gradual moves if converting large sums. Currency timing is rarely perfect. Thoughtful, small steps reduce risk. Traders and hedge funds will interpret this move through the lenses of macro data and central bank signaling. A modest upward recentering of the reference rate followed by a steady trading band says the bank is managing volatility, not courting a big appreciation. For macro traders, that reduces the probability of a sudden revaluation windfall and increases the emphasis on incremental yield and carry trades. For investors in Vietnamese bonds or equities, the signal matters for expected inflation and policy consistency. A stable or slightly stronger currency helps to anchor inflation expectations, which can be supportive for real returns if growth remains strong. Hedge funds will monitor liquidity in the interbank market, cross-border capital flows, and any evidence that the central bank is intervening actively to smooth moves. In short, market participants will treat this as deliberate, cautious policy rather than an open invitation to speculative carry trades. Let's zoom out. How does this fit into Vietnam's broader economic story? Over the last few years, Vietnam has sought to balance rapid growth with macro stability. The country's export-led model, rising manufacturing output, and growing tech investment have all boosted GDP prospects. At the same time, global pressures, like U.S. monetary policy shifts and supply chain disruptions, complicate exchange rate management. The central bank is responsible for keeping inflation under control while supporting credit growth and employment. Adjusting the reference rate modestly fits a strategy of gradualism, allow exchange rates to reflect market realities while avoiding shocks that could hurt exporters or destabilize local credit. Recent reports also show the authorities eyeing higher growth targets, with careful attention to currency and credit channels, which makes this currency adjustment one part of a broader playbook. Now, a practical scenario for businesses with dollar exposure. Imagine a Vietnamese manufacturer buying components priced in dollars. A firmer dong reduces the local currency cost of those inputs. If that manufacturer passes savings to consumers, it can win market share. If it instead invests savings in productivity or hedging, it strengthens long-term competitiveness. Conversely, an exporter selling abroad in dollars may see dong revenues decline if the dong strengthens. To protect margins, the exporter could renegotiate contracts, increase local efficiency measures, or use currency forwards to lock in rates. For Iraqi businesses trading with Vietnamese partners, the subtle change in the dong can slightly alter invoice settlements, so transparent contract terms and agreed currencies matter now more than ever. Small currency shifts change the calculus of sourcing and pricing in real business decisions. There's also the banking angle to consider. Commercial banks adjust their retail buy-sell spreads based on the trading band and daily midpoint. If the central bank nudges the midpoint up, banks will typically lift their buy rate and selling rate in parallel, passing through much of the technical move to customers. The size of the spread and transactional fees determine how much of the central bank adjustment reaches depositors and borrowers. Banks with larger foreign exchange operations may hedge their positions or change liquidity buffers to protect profit margins. For correspondent banking networks, the channels that connect Iraqi dinar flows and Vietnamese banking, changes in how banks position dollar liquidity can affect settlement windows and fees. Corporates and individuals should compare quotes across providers to ensure they're getting the best available rate given the new reference. Risk management: what to watch for in the coming weeks. First, monitor whether the dong holds its new level or reverts. If the midpoint continues to trend upward consistently, that's a stronger signal of structural appreciation and requires strategic adjustments. If it bounces back and forth, volatility risk rises and hedging becomes more valuable. Second, watch domestic inflation reports and monthly trade data. If stronger currency is accompanied by lower import prices, inflation could ease. But if growth picks up sharply and credit expands quickly, inflation could reassert itself and force policy tightening. Third, pay attention to global money conditions. Decisions by the U.S. Federal Reserve or sudden shifts in commodity prices can change capital flows into emerging markets. Smart managers combine local monitoring with global macro awareness to adapt. How should policy observers and analysts assess the credibility of the move? Credibility depends on consistency and communication. If the central bank follows the move with clear commentary about the reasons and a consistent application of the trading band, markets will read this as credible incremental policy. If the bank oscillates or intervenes heavily without explanation, credibility might weaken and volatility could rise. For long-term investors, a central bank that shows carefully calibrated actions and transparent rationale is preferable to one that makes surprise, large swings. Analysts will look for accompanying signals, statements about inflation, credit growth limits, and macroprudential adjustments. Together, these form a coherent picture of policy intent. Let's talk timing. Should anyone rush to convert money now? For most people, the answer is no, unless you have a clear short-term transactional need. Currency timing is notoriously difficult. The prudent approach is to assess your exposure, compare current bank rates, and consider gradual conversions or hedging if you face substantial amounts. If your plan is travel or modest remittance, the marginal gain from timing is likely small compared to fees. For businesses and investors with significant exposure, consider speaking with treasury professionals about forwards, options, or staggered conversion schedules to smooth the risk. The principle is straightforward: match the strategy to the exposure and avoid emotional. Now, a plain language checklist for viewers. 1. Check the official daily reference rate and compare commercial bank quotes before making exchange decisions. 2. If you're a business, review contract currencies and consider whether hedging tools are needed. 3. Travelers should shop around for exchange services and avoid last-minute airport conversions. 4. Investors should watch central bank communications and macro indicators rather than single-day moves. And 5. Anyone with large exposures should consult a professional for tailored hedging strategies. These are practical steps that convert abstract policy news into actionable moves you can use right away. What about the political angle? Currency policy rarely happens in a vacuum. The government and central bank coordinate to support growth targets while guarding stability. Political directives around credit policy, incentives for investment, or trade arrangements influence how exchange rate moves are designed and communicated. In Vietnam's case, efforts to promote growth while managing inflation and credit have been visible in policy discussions over the past year. Observers will watch for any fiscal moves or regulatory changes that complement the currency step. For example, adjustments to credit caps or incentives for strategic sectors, because those would signal a broader strategic pivot rather than an isolated technical fix. Stay aware of policy bundles, not just single headlines. Now let's cover possible negative scenarios so you know what to guard against. One risk is that speculation magnifies the move. If traders interpret a small adjustment as the start of a larger revaluation and pile in, the market could overreact, forcing the central bank to reverse course. Another risk is that global shocks, like sudden hikes in U.S. interest rates or commodity price spikes, could overwhelm the central bank's efforts and push the dong off its intended path. Also, if inflation surprises on the upside, the bank might need to tighten policy, which affects credit and growth. The sensible play is scenario planning. Consider best case, base case, and stress case outcomes and assign probabilities so you can size responses appropriately. Turning back to the human element, for ordinary Vietnamese citizens, a firmer dong can lower the cost of imported goods and certain services, improving living standards in small but meaningful ways. For people paid in dong, wage adjustments and job market conditions determine how much of that benefit is realized. For students, travelers, and families receiving remittances, better exchange power can ease expenses. However, these benefits often arrive gradually as markets and prices adjust. The important reminder is that macro moves have real, varied consequences. Some groups gain quickly, others feel changes indirectly over time. Good policy aims to spread benefits while minimizing shocks to vulnerable sectors. How will global investors likely react in the medium term? Investors will watch for consistency more than a single day's number. If the central bank continues to demonstrate measured, transparent adjustments that align with inflation and growth targets, foreign portfolio and direct investment may increase because predictability reduces risk premiums. If the adjustment is paired with strong growth signals and stable credit metrics, Vietnam's attractiveness as a regional manufacturing and tech hub could strengthen, but investors will also weigh geopolitical and global macro conditions. The net reaction will depend on how Hanoi sequences this currency step with the rest of its economic program. A few words on data: keep an eye on upcoming trade balance figures, monthly inflation prints, and central bank minutes or statements. Those are the data points that will confirm whether the currency move is a one-off technical adjustment or the start of a longer trend. Also watch liquidity indicators in interbank markets. If the central bank is intervening heavily, you'll see changes in money market rates. These signals tell you whether to expect steady policy or further action. For analysts and business planners, create a monitoring dashboard with these indicators so you're not reacting to every headline but responding to confirmed trends. Now, a presidential nidisa, a presidently made a publicid the remittance corridors if your business or family depends on transfers between Iraq and Vietnam. Check with your correspondent bank about any changes in settlement timing or fees. Small moves in the dong dollar corridor can slightly change the cost of routing funds through intermediary currencies and banks. Where possible, negotiate contract terms in a stable currency or use built-in adjustment clauses to share currency risk. Transparency in invoicing, specifying currency, conversion date, and bank fees reduces disputes and preserves margins for both buyers and sellers. These steps turn macro risk into manageable contractual language. What about market narrative and media framing? Headlines that say revaluations sound dramatic. The reality here is more nuanced. The central bank nudged a reference rate and the market reacted modestly. For viewers and subscribers, the lesson is to read beyond the headline. Check the numbers, verify the band, and pay attention to central bank commentary. Labels matter. Revaluation implies a large, policy-driven one-time increase, while adjustment to the reference rate is typically smaller and technical. Use careful language when discussing currency moves to avoid misunderstanding and unnecessary alarm. Finally, what's the bottom line for our viewers? Vietnam's move is meaningful but measured. A modest upward adjustment to the reference rate that signals a policy of cautious alignment with current market conditions. It helps control inflationary pressure from imports and signals policy confidence, while avoiding shocks that would hurt exporters. For travelers, savers, and businesses, the immediate effect is marginally positive if the dong holds its new level. For investors and traders, it's a policy signal to watch for consistency and follow-through. For Iraqi dinar watchers and regional market participants, the main takeaway is the reminder that emerging market currency moves are interconnected, and well-communicated gradual policy steps tend to be more stabilizing than sudden reversals. Keep monitoring official rates, bank quotes, and macro data. Be pragmatic, not panicked. Thanks for watching this deep dive. If you're running a business that trades with Vietnam, managing remittances, or just tracking emerging markets, use the checklist I shared to compare bank quotes, assess contract exposure, consider hedging for large sums, and watch the next inflation and trade reports. Hit like if this was useful, subscribe for timely market updates, and drop questions in the comments. I'll address the most common ones in a follow-up. Also tell us, are you directly affected by this change or watching from afar? Share your experience and we'll build practical follow-up coverage based on what you need. Stay informed, think strategically, and we'll keep tracking how this story develops.